Hey everyone, and welcome back to the channel. Today, we're diving deep into a topic that has been making headlines for years: Turkey's economy. Once hailed as a roaring success story, a model for emerging markets, Turkey has spent the last decade lurching from one crisis to another. We've seen soaring inflation, a collapsing currency, and a cost of living crisis that has pushed millions to the brink. So, what happened? How did a nation that experienced a spectacular economic boom find itself in such a precarious position? To understand the present, we have to look back at the past. In the early 2000s, Turkey was on a roll. After a devastating financial crisis in 2001, the country embarked on a series of major economic reforms. Under the new leadership of the AKP and Recep Tayyip Erdogan, Turkey embraced fiscal discipline, privatized state-owned enterprises, and courted foreign investment. The results were astonishing. Between 2002 and 2007, the economy grew at an average rate of nearly 7% per year. Inflation was brought under control, a new middle class emerged, and cities like Istanbul were transformed by massive construction projects gleaming skyscrapers, new airports, and sprawling shopping malls. Foreign capital flooded in, attracted by high interest rates and the promise of a stable, growing market. For a while, it seemed like Turkey had cracked the code. It was the poster child of economic success. But beneath this shiny surface, vulnerabilities were growing. This incredible growth was heavily dependent on a steady flow of cheap foreign money. Think of it like building a house with a credit card. As long as you can keep borrowing at low rates, you can keep building bigger and better. But what happens when the credit line gets cut or the interest rates spike? That's exactly what started to happen. Global financial conditions began to change. The US Federal Reserve started signaling an end to its era of easy money, making borrowing more expensive for emerging markets like Turkey. This is where the story takes a turn. Moving from a boom fueled by external factors to a crisis driven by internal policies, the government's focus shifted from orthodox economic management to a growth-autocracy model. The problem was, this growth was still being financed by debt, both public and private. The construction boom continued, but much of it was creating an asset bubble rather than productive capacity that could generate real, sustainable income, especially foreign currency. Think of building more and more shopping malls instead of factories that export goods. One brings in local currency, the other brings in dollars and euros. When your debts are in dollars and euros, you desperately need the latter. And then came the most controversial part of Turkey's economic story: the unorthodox monetary policy. For decades, the central banking playbook has been clear. When inflation is high, you raise interest rates. This makes borrowing more expensive, cools down the economy, and helps bring prices back under control. However, President Erdogan has long held the unconventional view that high interest rates cause inflation. Against all mainstream economic theory, he has repeatedly pressured the central bank to cut interest rates, even as inflation was spiraling out of control. This created a massive problem of credibility. Investors, both domestic and foreign, lost faith in the central bank's independence and its ability to manage the economy. Why would you keep your money in a currency that is rapidly losing value, while the official interest rate is far below the rate of inflation? It's like putting your money in a savings account that guarantees you lose purchasing power. Naturally, people and businesses started selling their Turkish lira and buying foreign currencies like the US dollar and the euro to protect their savings. This is what we call dollarization. This massive sell-off caused the lira to plummet in value. A falling currency creates a vicious cycle. Turkey imports a lot of things, especially energy and raw materials for its factories. When the lira falls, the cost of these imports skyrockets. A car part that cost 100 lira yesterday might cost 150 lira today. Businesses have to pass these higher costs on to consumers, which means prices for everything from bread to gasoline go up. This in turn fuels even higher inflation. By 2022, official inflation rates were soaring past 80%, though many independent economists argued the real figure was much higher. For ordinary Turkish citizens, this has been devastating. Savings were wiped out, salaries couldn't keep up with the rising cost of living, and basic necessities became luxuries. The government tried various measures to stop the bleeding. They spent billions of dollars from the central bank's foreign reserves to prop up the lira, but it was like trying to plug a dam with your finger. They introduced special savings accounts designed to protect depositors from currency depreciation, but this just shifted the financial burden onto the state budget. None of these measures addressed the root cause: a lack of confidence in the country's economic management and its central bank. Following the 2023 elections, there was a significant shift. President Erdogan appointed a new economic team led by respected figures like Finance Minister Mehmet Şimşek and Central Bank Governor Hafiz Gaye Erkan, who were known for their orthodox economic views. This was seen as a major pivot back towards conventional policy. Almost immediately, they began a series of aggressive interest rate hikes, raising the policy rate from 8.5% to over 40% in just a few months. This was a clear signal to the markets that they were serious about fighting inflation. The goal of this new policy is to break the cycle. By raising interest rates, they aim to cool down domestic demand, encourage saving in lira, and stabilize the currency. It's a painful but necessary medicine. Higher interest rates mean a slower economy, at least in the short term. Businesses will find it harder to borrow and invest, and we might see an increase in unemployment. It's a tightrope walk. They need to bring down inflation without tipping the economy into a deep recession. So, where does Turkey go from here? The path to recovery will be long and challenging. Rebuilding trust with international investors takes time. Taming inflation that has become so deeply embedded in the economy is a monumental task. The new economic team has made a decisive break from the past, but they face immense political and social pressure. The cost of living is still incredibly high, and people are weary after years of economic hardship. Will the government have the patience to stick with this painful but orthodox policy long enough for it to work? Turkey's story is a powerful cautionary tale. It shows how a decade of incredible progress can be undone by unorthodox policies, the erosion of institutional independence, and an over-reliance on foreign debt. It highlights the critical importance of a credible and independent central bank in maintaining economic stability. But it also shows a nation's resilience. The recent policy U-turn offers a glimmer of hope that Turkey might be on the path to finally taming its economic demons. The world is watching to see if this pivot will mark the beginning of a new, more stable chapter for the Turkish economy. What do you think? Will this new approach succeed? Let me know your thoughts in the comments below. Thanks for watching, and if you found this video insightful, please give it a thumbs up and subscribe for more deep dives into global economics. See you in the next one.